Big recording. This was
Very
just
good. Okay. Well, good morning, everybody from Washington. Good afternoon and good evening to those of you watching, participating from Europe and Asia. I'm Charles Collins. I'm the director of the Independent Evaluation Office of the IMF. Welcome to this virtual seminar on our new evaluation on the IMF's advice on capital flows. As I think you all know, the difficult questions of how quickly to open up capital accounts and particularly how to handle volatile capital flows have long been issues of concern and intense debate, which lie at the heart of the IMF's core areas of interest. We decided last year to do an evaluation of the IMF advice in this area, 8 years after a major overhaul of the IMF's framework for giving advice on capital flows that culminated in the so-called institutional view on capital flows. And the relevance of this topic has been underlined by the extraordinary period of turbulence in portfolio flows that occurred in the early days of the COVID-19 crisis. Our team completed the evaluation, submitted it to the board a couple of months ago, and it was discussed in the middle of September. And the report and all the background papers are available on our website. This is our first public outreach event for this evaluation, and I have to say we're very excited about the possibilities of this virtual format. I see that we have over 200 participants in this event coming from at least 4 continents: North America, Latin America, Europe, and Asia. We also have panelists joining us from Europe. So this really does allow us to broaden our outreach beyond what is possible through physical means. And I'm pleased that we have 3 excellent panelists. Patrick Honohan joining us from Dublin. Patrick, as I'm sure you all know, is former governor of the Bank of Ireland. He's an honorary professor at Trinity College Dublin, a non-resident senior fellow at Peterson, and a contributor to one of the background papers in the evaluation. Then we have Steve Kamin, former director of the International Division at the Federal Reserve Board, and now resident scholar at the American Enterprise Institute. And finally, Adnan Mazarei, a former senior IMF staff member and also a senior fellow at Peterson. So they will have a chance to comment on our report. But first, we're going to have a presentation of the report from the team leader of the evaluation, Prakash Loungani, who has been working with the IEO for the last 2.5 years or so, and has done a great job in putting together this report. So let me pass over to Prakash. He'll give a presentation of maybe 20 minutes or so. We'll then turn to each of the panelists for their comments, and then open up for general Q&A. So over to you, Prakash.
Prakash, you're muted.
Okay. So thank you all for coming. It's wonderful to have so many people from all over the world. And I want to welcome many of our consultants who are in the audience. Hans Genberg, Ila Patnaik, I think Karnit Flug is joining as well, Eduardo Borenstein, as well as several people who we have been speaking to as we prepared this report. The Financial Times just had a story this morning on the challenges that many countries, particularly emerging markets, are facing as foreign investors are selling emerging market stocks and bonds. According to the Institute of International Finance, which tracks capital flows sort of in real time, after the sharp sell-off in March this year, there were capital inflows into emerging markets. But since September, there have again been sell-offs and some softness. And there are, according to the IIF, again, clouds on the horizon. So this is a reminder that sudden stops and surges of capital flows remain a big policy challenge for many countries at present, as they have in the past. Countries faced similar challenges during the global financial crisis. And this led the IMF to adopt the so-called institutional view, a warning to generalists that I and other speakers might shorten institutional view to IV. So the IMF adopted this IV on how countries could use capital controls and other instruments to deal with capital flow volatility and other instruments, among other instruments. So what our report does is to assess how well IMF advice to countries has fared since the adoption of the institutional view. Our report relies on very detailed work conducted by renowned experts. We have country cases. We do a total of 27 country cases covering a spectrum of countries. We actually also include in our case studies several countries that for one reason or another have chosen not to use capital controls. So we want to give the readers an experience of how countries that have chosen not to use a particular instruments, how is it that they deal with capital flow volatility as well. We also have several thematic papers. Two of them I would draw your attention to because they are very detailed and useful surveys of the literature. One on the theoretical advances that was done by Anton Korinek, whose picture you see here, and the other on the empirical evidence on the use of capital controls, which was done by another well-known expert, Peter Montiel. So here are our main findings on the IMF's bilateral advice, namely the advice it gives to particular countries. Our main finding is that the IMF deserves substantial credit for upgrading its framework for providing advice. IMF staff have worked extremely hard to make the advice consistent across countries, tailored to the circumstances, and even-handed, in the sense that advanced economies have received the same lectures, if I may put it that way, as emerging markets. But there are also several issues, and I will list the issues. And since I will go over these issues one by one, I'm not going to stay on this slide for any longer. The first issue that we flag is that both country experience and recent research suggest that the IMF should be more flexible, or at least consider being more flexible in the use of capital controls, or in what is in the jargon referred to as capital flow management measures, CFMs. So I will use capital controls and CFMs interchangeably in this talk. So both country experience and recent research suggest that CFMs, capital controls, could perhaps be used preemptively in certain circumstances. In our review of the country's cases, we find that Korea, for instance, has been able to use reserve requirements on foreign currency deposits quite usefully as part of its framework of guaranteeing financial stability. Peru likewise has been able to manage a fairly heterodox policy toolkit quite successfully. Iceland in 2016, after they had overcome much of the crisis and were facing capital inflow surges, again wanted to use this somewhat preemptively because they didn't want another crisis like the one they had just lived through. So there are many instances that we cover. Hans Genberg's paper on ASEAN countries also provides several experiences of countries that in the region that have been able to use capital controls preemptively to sort of ward off crises rather than get into one. We also make the case that CFMs can expand the policy space that is available for standard tools such as monetary policy. And in fact, the IMF's own research that is underway suggests that preemptive use of capital controls can be effective in particular circumstances, for instance, where foreign exchange markets are shallow, where there are deep or sharp currency mismatches on balance sheets, where economies may be dollarized, and so on. Our next issue has to do with the labeling of measures. So what you're seeing on the left is sort of the mother of all Venn diagrams. If I tried to explain it to you, it would take up the 20 minutes that I have, and I would still fail at it, and I would have to bring in Nicoletta Batini, my co-leader on this project, whose picture you see here. The point of that chart is not to take you through it, but to convince you that trying to decide which bucket or which part of the diagram a particular measures belongs in is quite a difficult exercise. So there are three buckets that things can go into. One is capital controls or CFMs. The other thing is MPM, which are macroprudential measures for financial stability. And then there is an even more complicated category, which is called CFM/MPM. These are measures designed to limit capital flows and safeguard financial stability. So it's difficult. In an ideal world, we would know exactly which bucket things belong in, but there are gray areas. It's difficult to decide where measures belong. And the problem is that the choice of the label leads to a fork in the road in IMF advice. If a measure gets the label of MPM, it can be used preemptively and it can be kept in place permanently. Whereas a measure that gets the label CFM/MPM cannot be used preemptively. And while you can keep it for a somewhat longer duration, you still will be asked to take it off and replace it with something else, according to IMF advice. And we find that when we talk to country officials and to IMF staff, we find that deciding between these labels has taken up an crowded out policy discussion.
She said, how are you?
Could I remind everyone to mute themselves, please, so we don't get too much background? Thank you.
The third issue is on the role of foreign exchange intervention. The IMF advice tends to be for countries that have chosen not to peg, for instance, that countries should use exchange rate flexibility in the face of capital flow volatility. That is meant to be a big way in which you bring about your adjustment. But what we found and what the country experience reveals is that in many cases, exchange rate movements can actually be a shock amplifier. So again, in the study that Hans Genberg did, officials from Thailand felt, for instance, that exchange rate fluctuations in the particular episode they were talking about were driven more by herding behavior and sort of risk on, risk off type changes in preferences rather than by fundamentals. And so they were reluctant to use the exchange rate instrument as it would amplify the shocks in that environment rather than to dampen them. Work by the IMF's chief economist Geeta Gopinath on dominant currency pricing practices also raises questions about whether in such a setting, exchange rate flexibility can provide the stabilization benefits that standard theory says it should. So what we found is that as a result of all these issues, countries have been using much more foreign exchange intervention than you would think they would need to if exchange rates were doing the job that they were supposed to. And we find this particularly the case in Latin America a lot, which led the IMF to actually explore these reasons and do an in-depth study of why this was going on. And that's the book that you see featured here. The fourth thing that we talk about issue is dealing with disruptive outflows. And here, the point we make is that these are very difficult, stressful situations that countries face. And there is a need for sort of greater flexibility allowed in IMF advice and more sort of out of the box thinking, rather than saying, well, you really have to wait till you're in crisis or near crisis, and then we'll let you do whatever you want. But until you get that point, you have to, not really use capital controls and so on. And what we found, and these are studies done by Ishwar Prasad for China and Ila Patnaik for India, is that countries felt that IMF advice could have been more nimble and the validation of these measures could have been more forthcoming. So China in 2015, as you all know, faced severe stresses, used a sort of heterodox set of tools to ward off the pressures, but felt that the IMF, when approached for advice, wanted to vet each individual measure on a case-by-case basis against the institutional view, rather than saying, you're in a difficult situation, you're taking a package of measures, this is fine, go ahead. IMF validation came much later, and in fact, the IMF managing director at the time later said, it was good that China put in place these controls because it actually meant that the global financial system ended up being safer than it would otherwise. In the case of India, during the taper tantrum, again, then Governor Raghurajan took a series of steps, sort of, again, heterodox, including some capital controls. IMF validation came 6 months later after the crisis had largely passed. So in these cases, we feel the IMF needs to show the flexibility needed to recognize that countries should not be allowed the flexibility when they are already deep in a crisis, but somewhat before that. Our fifth issue has to do with the use of capital controls for some social objectives, such as providing affordable housing. Now, some economies, the ones that are listed here, have used capital controls in recent times to limit the non-resident inflows into their real estate sectors, to limit house price inflation and keep housing affordable. Now, these economies are widely regarded as flag bearers for open capital markets. So they have been very surprised to be classified as countries that are trying to limit capital flows. They argue that they are taking these measures not to become closed economies, but simply to insulate one particular sector of their economy from particular price pressures and to keep housing affordable and meet an important social goal for their economies. So it's not surprising that the word housing does not occur in the 2012 document called the institutional view, but we think it would be odd if the 2021 revision of the document also does not make any mention of housing. And finally, there are some technical challenges that have come in the way of implementation of the institutional view. The advice that the IMF gives on CFMs or capital controls rests on metrics that have not always proven fully convincing to authorities in countries. One particular metric that is used is the external balance assessment, namely the IMF's view on whether the country's currency is fairly valued or whether it's over or undervalued. In many, many cases of our 27 countries, there were instances where the country officials did not agree with the IMF's assessment of their exchange rate, and therefore there were disagreements about the policy toolkit that was needed to manage the situation. One example is Israel, and the picture that you are seeing, as many of you will recognize, is of Karnit Flug, the former central bank governor who did the country case study for us. And this was a case where the Bank of Israel, over much of the period from 2009 to 17, thought that the shekel was overvalued and therefore that some intervention was needed, whereas the IMF took the view that the shekel was fairly valued and the intervention should not be occurring. So this was not an isolated case. Malaysia, Thailand, Peru, and others in our case studies all felt that the IMF's assessment of their exchange rate was flawed, and therefore the advice on the policy toolkit, including the use of capital controls and foreign exchange intervention, was therefore also flawed. Similar disagreements on whether countries had adequate reserves in both directions. Sometimes the IMF thinking country had more than enough reserves and the country thinking otherwise. This was the case, for instance, China, when it was facing severe pressures, but also in the other direction where the country feeling it had enough and the IMF saying no. And these were cases of Poland and Croatia also surveyed by Karnit. And finally, the advice on capital controls requires making very difficult calls. We have to decide whether a measure is designed to limit capital inflows or whether it has other goals. It also depends on subjective definitions. Is the country facing a surge? Are the measures taken of macro relevance? Is the country in a crisis or near crisis? Again, it's the example that comes to mind is Iceland in 2016, when they wanted to impose controls. The IMF said, well, you're not facing a surge of the same magnitude that you faced before the global financial crisis. And they said, exactly, that's the point. I mean, we don't want to wait till we face another surge of that magnitude, given what happened last time around. So that's why we want to put these controls now. So I think that there has to be some thought to this country experience in thinking about how much flexibility the IMF is willing to allow. I will skip over most of the slides that follow because in the interest of time. We do have very interesting findings also on the IMF advice on capital account liberalization. We find there is broad appreciation for IMF advice. We did careful case studies of Ethiopia, Kenya, and Morocco. These were done by Karim El Ainoui of the Policy Center of New South and Jose Ocampo. There was satisfaction that the IMF is no longer in the sense of being an ideological sort of pusher of capital account liberalization, but it's taking a very guarded approach. The IMF has had to make a number of difficult calls. The paper by Ishwar Prasad and Ila Patnaik that I mentioned earlier reached the view that the IMF was almost being too cautious. There were opportunities for pushing ahead with reform, which would have given benefits to the countries, and these opportunities were not taken. In contrast, the IMF advice to Argentina may not have been cautious enough, and Argentina rapidly removed controls some years back. The IMF did not warn sufficiently forcefully that without the preconditions being in place, this could lead to a difficult problem down the line. We also have a very detailed discussion of multilateral advice, a very nice background paper prepared by Chris Toe. And we find again that the IMF has worked extremely hard to adapt its framework, but nevertheless, there is concern that IMF advice to source countries, the major advanced and emerging countries, doesn't really get traction. It's not listened to. We also have an important discussion of the coherence between the IMF's institutional view and other multilateral frameworks, such as the OECD's Code of Liberalization and the Basel III framework. I know that there are colleagues here from the BIS and the OECD. There is time in the discussion. We could return to these issues. I'll be even briefer on this monitoring, research, and analysis. We do find that the fund has made important contributions along a series of dimensions. We find that the work is good, but until the integrated policy framework came along, seemed to suffer from the lack of a sustained medium-term agenda and sort of a clear sense of direction. So to summarize, our principal takeaway is that the passing of the adoption of the institutional view in 2012 was a major step forward. Its basic principles remain valid, but nevertheless, after 8-9 years, you cannot rest on your laurels. I think when the IMF staff, management, and executive board sit down next year to review the institutional view, they should, of course, give themselves a huge pat on the back for what they did back in 2012, but then roll up their sleeves and try to address some of the issues that I went through. So our main recommendation is that it's time to refresh the institutional view when it comes up for review next year. We say that we argue that the fund should consider allowing for preemptive and more lasting use of capital controls in some circumstances. The circumstances are listed here. I went over them in my presentation. Just to reiterate, there are cases when it should be the case when financial stability is the predominant goal of policy. The distinction between pure macroprudential measures and capital controls / macroprudential measures could be removed. We should look into the measures that countries are taking for housing affordability and reach a view on how we want to treat that. And we should recognize that use of capital controls can increase macro policy space. We also ask for a medium-term agenda for research on capital account issues along the lines of what is envisaged in the integrated policy framework. We also have a number of suggestions on how to strengthen multilateral cooperation. The IMF's executive board and management have broadly welcomed the report, but there have been a range of views among executive directors on the extent of revisions that are needed. We look forward to the management implementation plan that is going to be drawn up in about 6 months, which would be staff's concrete steps that they can take to make our recommendations, to implement our recommendations. And we also look forward to the review of the institutional view next year. And we hope that our report, as well as the work being done on the integrated policy framework, can lead to a major refresh of the institutional view so that it remains a state-of-the-art framework. Thank you.
So thank you so much, Prakash, for that excellent overview of what is really a rich and complex evaluation with very extensive case studies. And I see some of you have already been asking questions about particular country cases, which perhaps we can come back to later. But please do look at the case studies for a lot of detailed information and assessment. I should remind everyone that we do have a chat function. Many of you are already using it, but those of you who are not, please do use it to send in comments and raise issues and questions, which we will take up after the three panelists have had a chance to give their comments. So I will ask each panelist to speak in turn, and let me start with Patrick Honohan, who was contributor to one of our background papers, case studies of countries facing capital outflows, but also someone who experienced as governor of the Bank of Ireland the difficulties that dealing with that volatile capital flows can create. Although we didn't do any specific evaluation in this report on the European experience. We did there for those interested in that, we did an earlier evaluation of the euro area crisis. But let me turn to Patrick for comments on this evaluation. Patrick.
Thanks very much, Charles, and thanks for the invitation. It's again great pleasure to work with the IEO and with Prakash on this particular project. I'm not sure why I've been chosen to, as a representative of the background paper people, to talk here. Prakash said I could say a few words about the overall report, but to dig more into what I found in the process of doing the countries that I studied. So let me just start and use that. Oh, I'm not allowed to share the content. Nicole, could you possibly share my content? Okay. Just a remark about the overall report. The big takeaway that I have on the report is that the recommendations tend very much in the direction of having fewer categorical rules about capital controls. So the world has changed gradually since the late 1990s into a direction where the fund is tolerating a lot more capital control, even advocating the use of capital controls in certain instances. We can have the next slide, please. But it's avoided, the report has avoided what the risk here is anything goes. You can do anything because you can find some reason why it might be a good idea to have capital controls. I think it emphasizes the importance of enriching the research basis for having capital controls, acknowledging the complexity of situations. And it still respects the fund's traditional orientation towards open markets in general. So I would define this as a move from a policy police approach, which might have been there before 2012, and to some extent it maintained to a degree after the institutional review was published in 2012. It's moved from the policy police approach to a money doctor approach, to let's see what's wrong with you, let's see what can be done. Don't really like capital controls, but if necessary, we could use some bleach. So it's discretion with clear objectives. So enough about the overall report. Let me go to the background paper. I was asked to study three really interesting countries. Next slide, please. Countries where the controls were crisis driven. There are controls on outflows. There are three European countries: Cyprus, Iceland, and Ukraine. And I think at this distance from the events, we can perhaps say that these were countries with thrills and spills. So very interesting issues arising, very dramatic, fast-moving situations arising. The fund was involved with programs in each of these countries. It was also involved in the policy debate on capital controls. The fund did not initiate the controls in any of this, but it actually encouraged them when they were supported by appropriate fiscal and monetary policies. And this is a sort of, next one sentence is a sort of thing that you see in fund reports. The fund provided valuable technical assistance in helping authorities avoid or loopholes. But it's quite important because capital controls are complicated things, and market participants immediately say, oh, there are controls. Great. What are the loopholes? And I think that it was very valuable for countries to be able to draw on IMF experience, sometimes very technical experience, sometimes just common sense experience, but they saw what had happened before. There are a number of examples. The one I liked best was where in Iceland, I'm not sure the fund identified this particular one, but this is a loophole that was closed after a number of months, where a practice where big ticket items were purchased by, you want to export 100,000 euros worth of cash. You bought an expensive car abroad. You got the cash authorized. It's a current account transaction, so no problem. You get the money out, you pay for the car, and you cancel the car. The car never arrives, but the money has gone out. As a sort of example that if you're struggling with capital controls, you might not see things like that are happening. I could give you lots of other examples, but I won't take the time. Let me go to Iceland. Next slide, please. The fund, in the Iceland situation, September 2008, everything is collapsing. The authorities had said, okay, ad hoc controls, administrative restrictions, you can't have your money, get your money out because you don't have any money to give you, sort of thing. But the fund arrived, was called on to Iceland looking for a program. The fund surprised the Icelandic authorities in October 2008. The authorities had thought, well, the fund will come in, provide us with cash, and tell us to remove the capital controls. Exactly the opposite happened. The fund said, no, don't remove the ad hoc restrictions. In fact, we want to build the capital controls into the program. And this came as a bombshell to the authorities. They were surprised. They were not happy because capital controls were unpopular. A small country, a lot of relations with the rest of the world, but they went along with it. The basic objective, and that was recognized by the authorities, was to help protect the balance sheet of households and businesses who were heavily indebted in foreign exchange, because it had become quite a dollarized situation there. It was very controversial. It didn't avoid a major depreciation of the Icelandic kroner, but the offshore market was about 50% more depreciated, so it did have a significant effect. And academics, both at the time and later, expressed divergent views on whether these controls were needed at all. I have some quotes, famous people, I won't tell you who they were. One side of the argument, simply scrapping the controls after a short emergency period was never a serious option. Other distinguished academics, the imposition of the capital controls was both unnecessary and unjustified. Well, something then happened that made it quite a different environment to what people were thinking about in October 2008. Next slide, please. Gradually trying to dismantle these controls, finding some ways of reducing the overhang of money that wanted to go out. The authorities started to realize that this overhang of especially non-resident holdings of assets within Iceland was going to cause problems, exchange rate problems, balance of payments problems, reserves problems. How could they deal with this situation? And I'll just take one pocket of it, the most interesting one, which was the block of funds which claims related to the failed banks, claims by non-residents on assets inside Iceland which had been recovered from the failed banks. These were trapped behind the exchange controls for years, for 7 years. And then they were released only after a haircut. It was called a stability contribution. And it was a stability contribution, yes, sounds very nice, but there was the threat, there was legislation. If the stability contribution had not been paid, and clear indications were given about what size it would be appropriate, the money would not have been released, or it would only have been released with a major tax. And this was a very substantial payout by the creditors of the failed banks. It was enough to pay for the local depositor bailout that had happened in 2008. Lots of people thinking Iceland did not guarantee depositors, did guarantee the depositors in the onshore branches. 17% of GDP was paid in this exit tax, if you like, wasn't a tax, exit tax of trapped funds behind the capital controls. That was never envisaged I can't find any evidence, I'm discussing with participants, that nobody ever thought in 2008, we'll put the capital controls in and we won't let anybody out until they pay a huge exit tax. Nobody had that plan, but that's how it was used. And that was a clear and very substantial benefit to Iceland. Fund did not design this mechanism. It adhered to its duty of neutrality in this kind of negotiation, but it did not critique the solution, the homegrown solution that was adopted. Let me move on to Cyprus, which was my second country. And next slide, please. But again, it's a bank-dominated crisis, outflows. Capital shortfall of the banks was 50 or 60% of GDP. There were massive deposit outflows. So emergency liquidity assistance from the European, the Eurosystem through the Central Bank of Cyprus reached nearly 2/3 of GDP. So you're talking about very large sums relative to this rather small economy. The fund insisted that the government would not be required to pay for the recapitalization of the banks. So this was a new departure for in the various European crises that had occurred. And I think without the fund's participation, it's clear that this would not have been the solution, and there would have been a burden on the Cyprus authorities. But that's not about capital controls. But the consequence of the bail-in of the depositors, the uninsured depositors, 95% haircut in one of the two big banks, almost 50% in the other one, where the people who were bailed in did get equity in that bank. It is clear that might trigger further outflows, despite the recapitalization of the banks that had occurred through the bail-in. So what was to happen then? The remaining depositors who hadn't been haircut were likely to leave. And in fact, many of them did leave, despite capital controls that were introduced. These controls, of course, were damaging and distorting. So why do it? And why do I say that? Because you say, well, the money is going to flow out. But the sums involved were small relative to the euro system. The euro system could easily have financed these outflows. They could have found legal expedients for devices for doing that. The system was recapitalized, and the euro system should have said, well, people in charge should have said, well, the banks are recapitalized. There's no reason for deposits to flow out. They'll flow back in again when confidence is restored. But that didn't happen, and the fund did not block that. So capital controls were introduced in Cyprus within the euro system. And remember, there had been no threat of a currency collapse, which was the reason for introducing capital controls in Iceland. Don't let the currency collapse get out of hand. There would be no currency collapse in Cyprus because they're using the euro. So it's interesting there that the fund acquiesced in the capital controls, given the fact that there was no adequate ECB commitment to an adequate liquidity backstop. So that's an interesting case is Cyprus. And final case is Ukraine. Next slide, please. Possibly less exciting and interesting case, although it must have been pretty exciting and terrifying for participants at the time. It's a more complicated case. I'll be very brief on it. There are various stages. There's an early stage running up to 2014, where the fund is critical of the capital controls that already have been built in. The fund is in a program or a series of programs with Ukraine. It sees the capital controls as distorting, leaky, and will not support them because there is no sustainable or transparent monetary and fiscal policy. There's a nice quotation there. They said, operating the highly managed exchange rate regime for most of the past 2 decades included restrictions and regulatory constraints that introduced significant distortions. They were not transparent, they allowed for excessive discretion, and were difficult to reverse. That was the fund's view, and that was why the fund did not support these capital controls in that early period. They didn't like the idea that the country was trying to hold on to a peg. And if we move to the next slide, you can see that peg from 2000. There was a bit of a blip around 2008, but it stays steady then for 6 years. Some people were able to get their money out. Other people were not able to get their money out. The whole situation was unsustainable. Go back to the previous slide, please. Then a reformist regime came in 2014. So we're moving to market-oriented reforms, European-style policies. Governor Gontareva came in, great confidence, and a new program being negotiated. But in the background, a lot of bad things are happening. There's military activity in the eastern provinces. You know all that whole story in 2014, and there is a huge outflow. And if you saw a big spike in the exchange rate that I showed you a minute ago, the reformist government suddenly decided that they were going to introduce controls more draconian than anything that had ever been introduced. And they decided at a moment when the fund board was about to approve the new program. The staff had no idea. They sent the document to the board. They had to follow it up with a supplementary note saying, oh, by the way, draconian capital controls have been introduced. But soon the fund recognized that this kind of circuit breaker, temporary control was very helpful. And they've had a constructive relationship, engagement with the Ukrainian authorities since then, and even started to become so enthusiastic about the effectiveness of the controls that they wanted to slow the liberalization program, which has been in progress and which is, I think, largely complete now. My final point, and I have one more slide if we move two slides now. Yes, this one. Back to Iceland. And Prakash has already mentioned this situation. By June 2016, confidence has returned. Tourism is big. And the authorities are worried about an inflow again. So they say, well, let's introduce some capital inflow measures. We'll slow that inflow. But the fund now, despite their enthusiasm for everything that Iceland has done up to now, opposes this. It says, wait a minute, the institutional review says controls on inflows are not to be used preemptively. Well, that didn't resonate with a country whose economic collapse might have been avoided if they'd had controls there a decade earlier. So the authorities resisted, and they just went ahead with those controls, although they now have reduced them to a kind of zero level. And they rightly noted, I think, that waiting until inflow surge would be fully underway might be far too late. So overall, my conclusion is that what I saw was the fund was not doctrinaire. It was not always in the driving seat. It was adaptable. The staff looked at the situation as it was evolving and maneuvered to achieve the most effective result. It was consistent with the institutional view. The staff stuck with it. They were consistent with the institutional view even before the institutional view was adopted. And sometimes were constrained by the institutional view, as I gave the example of Iceland. So thanks very much. That's all I wanted to say.
Thanks very much, Patrick. That was a really interesting discussion of some of the flavor of some interesting case studies that you put together and some overall thoughts on the evaluation. So now we'll turn to Steve Kamin, formerly head of the International Division at the Federal Reserve Board, where he thought deeply about these issues and continues to think deeply as he's now moved to the American Enterprise Institute. Steve.
Well, first, I'd like to thank Charles and Prakash for inviting me to share my views on this important topic and for giving me the opportunity to read some really informative and interesting papers written for the project, like the one that we just heard about. So let me start by noting that President Harry Truman famously once said, "Give me a one-handed economist." All my economists say on the one hand, on the other hand. Well, I'm glad that President Truman didn't come to me for advice on capital controls, because on this issue, I am so conflicted, I actually need three hands. So first, on the one hand, like most economists, I like to let the markets make economic decisions when possible. And it seems very arbitrary to let national borders interfere with the process of allocating capital around the world. So imagine the US being split down the middle into like an East US and a West, or a North US and a South. Would it make sense to then segregate the country's capital markets so businesses in Arizona couldn't borrow from banks in New York, or firms in Virginia couldn't issue bonds in California? Not unless there were really very extenuating circumstances. On the second hand, however, there are indeed plenty of such extenuating circumstances, or as economists like to call them, externalities. And the background paper for the report by Anton Korenek does a very nice job of laying out a lot of these. I want to highlight just a few. So for starters, global investors are prone to indiscriminately lumping together all the borrowers in a given country into their own particular basket, which leads to pronounced surges of capital inflows in good times and outflows in bad times. And moreover, while host governments can use their regulatory and supervisory apparatus to insulate banks from such surges, they have a lot less scope to prevent booms and busts in the external borrowing of the non-financial sector, short of capital controls. And finally, during such episodes, exchange rates act as an amplifying mechanism, rising and thus bolstering balance sheets in the good times and falling and weakening creditworthiness in the bad times. As pointed out both in Anton's paper and in the work of the IMF's broader integrated policy framework analysis, these externalities create the scope to use two measures that were policies non grata in the IMF's longstanding pre-institutional view approach, which is exchange market intervention and capital controls. But on the third hand, while such policies may be desirable from a theoretical perspective, they may pose problems when being implemented by real governments in the real world. So capital controls and exchange rate intervention can and have been used to implement beggar thy neighbor policies that keep exchange rates undervalued. In other cases where the problem is capital outflows rather than inflows, such policies can and have been used to prop up overvalued currencies, thereby substituting for appropriate monetary and fiscal restraint. Moreover, extensive FX intervention to stabilize exchange rates can actually lead in the longer term to excessive dollar borrowing to stabilize exchange rates by reducing the apparent risk of currency fluctuations. And then finally, even in the absence of more nefarious motives, implementing capital controls in a transparent, predictable, and well-calibrated fashion requires sophisticated, prudent, non-political governance. And this is not always forthcoming in many jurisdictions. So thinking about the conflict between these three hands, the institutional view that was laid out in 2012 seemed like a very reasonable compromise between theoretical and pragmatic considerations. It acknowledged that capital controls could be useful, but to keep them from being widely used as a first line of defense, it limited their application to surges in capital inflows and outflows. But like any compromise, the institutional view was necessarily imperfect, and that means it could be improved on. And so the IEO report that Prakash described is a very welcome addition to the policy debate. It makes three broad recommendations, two of them to pursue further research on capital account issues and strengthen multilateral cooperation, are certainly anodyne and should be supported by any economist or international bureaucrat that seeks additional consulting or employment. The third recommendation, to widen the scope for capital controls to be used on a more regular basis, is considerably more substantive, and I want to focus on two key proposals in that area. The first is to allow for preemptive and more long-lasting use of capital controls in some circumstances. Here, if I may mix and mangle my metaphor, the third hand of governance considerations cuts both ways. On the one hand, this is a recipe for much more extensive use of capital controls than envisaged in the institutional view. And to the extent that there are concerns about the governance of these controls, preemptive and more long-lasting controls would exacerbate those concerns. But on the other hand, governments in the real world are already using these controls, and confining them to periods of surges in capital inflows or outflows could make it more difficult for authorities to implement those types of measures in a well-designed, transparent, and predictable manner. Furthermore, just as it's almost impossible for authorities to judge in real time whether an asset bubble is in process or not, it's also difficult to judge when a surge in capital flows is occurring that ought to be restrained. So balancing out these considerations, rather than having policymakers try to identify capital surges in real time and limit controls to those periods, I'm okay with. In fact, I support the more preemptive and long-lasting approach toward capital controls recommended in the IEO report. But success is certainly going to require that the IMF provide significant and granular guidance on best practices regarding how, when, and under what circumstances to enact these controls, in order not just to satisfy theoretical conditions for appropriate policy, but also to promote more effective and pragmatic policy implementation. And that, of course, is something that the IEO report is indeed advocating. Now, a second and related proposal that I'd like to highlight is to reduce the hard distinction made in the institutional view between capital flow measures and macroprudential measures. Now, on the face of it, this suggestion by the report seems quite sensible, since both types of measures can be used to promote financial stability, and therefore relaxing the distinction between them kind of would focus the discussion less on labeling and more on effective means of building financial resilience. Nevertheless, the proposal ignores one of the governance considerations that underlying the compromise that was embedded in the institutional view in the first place, which was to ensure that countries don't use capital controls as a means of making their currencies more competitive. And that's why in the institutional view, capital controls were only recommended as a response to heavy inflows when the exchange rate was not undervalued, the economy was not operating below capacity, and international reserves were already adequate. So as Peter Montiel points out in his excellent background paper for this report, those strictures are not necessarily justified from the standpoint of optimal economic policy. But those strictures are a lot more understandable if the objective is to keep countries from depressing their currencies for competitive advantage. And to the point that the distinction between capital controls and macroprudential policies has led to acrimonious and unproductive arguments over labeling in the past, these arguments presumably would lose a lot of their urgency once longer-term use of capital controls was allowed, so that just labeling a capital control did not necessarily take it out of the running for use. So bottom line, I'm comfortable with expanding the use of capital controls to be more preemptive and long-lasting, but I think that retaining the distinction between capital flow measures and macro-pru measures may be helpful just to ensure that the policy discussions don't ignore these salient considerations. So to wrap up, the IEO's revisiting of capital flow guidance comes at an extremely opportune time, given the dislocation of global markets triggered by the pandemic. I think the recommendations will generally prove quite helpful. And I just want to reiterate the need to strike this appropriate balance between theoretical prescriptions and practical governance considerations. Thank you. That concludes my remarks.
Thank you so much, Steve. Very, very thoughtful remarks. And I have to say that I think you gave participants here a good flavor of the balance of arguments between the conceptual economic arguments and the political economy governance arguments, which the executive board also grappled with when they discussed our paper. I mean, people could see the summing up of the board discussion, which is also included on the website. And these are the difficult issues that will need to be considered as the staff and the board go on to consider possibly refreshing the institutional view to take on concerns that have been raised that we flag, but not at the same time opening up excessive use an anything goes environment, which I think no one on our team or at the board wants to encourage. Let me now turn to Adnan Mazarei, former IMF staff member, actually trying to apply the institutional view, and now at Peterson. Adnan.
Thank you very much, Charles, and thank you very much for having me. I found the paper and the background papers to be excellent. They do a very good job of tracing the evolution of the fund's thinking and policy. Issues that the report discusses, but I wish it was more pushy on those, and I hope that the when the IV is reconsidered, they will be given better consideration. The first is, as we've discussed, is the IV is arguably still considerably too favorable about the long-term benefits of capital account liberalization, and views capital flow measures as something that is supposed to be used sparingly and temporarily. The second one has to do with the issues of short-term policy. What rightly indicates that there's room for using capital flow measures in some countries' policy mix. But I would like to note that this view is arguably in contradiction with the IMF's new integrated policy framework. Let me push on these two issues, if you permit. On the bias in favor of liberalization, the IV treats volatility as a departure from the norm. I'm exaggerating, but not too much. I believe that volatility is the norm and has considerable costs for the emerging markets, and some of these have been mentioned. Which need to be stressed perhaps more is the cost of debt problems in emerging markets that are associated. And these days we are arguably seeing that the international financial architecture is still quite inadequate for dealing with debt problems. The report rightly notes of capital and that IV plays them. The same with private and the social costs of benefit. Now, in the discussions, there's considerable hope placed on controlling the push factors for capital flow to better international policy coordination. Frankly, I don't think the scope for that is large, and the fund is not going to have considerable impact on the policies of the Fed, Central Bank of Japan, and the ECB. Therefore, we need to accept that and therefore possibly move to greater use of long-term measures for controlling capital, especially to alter the composition of capital flows. The second capital measures in country mix. IV lexicographic approach. It starts with exchange rate, monetary, etc., and the capital flows are almost at the end. But as the integrated policy framework recognizes, this lexicographic approach may not be the best for all countries. The mix could and should include earlier use of capital flow measures to expand policy trade-offs. Therefore, and I think the integrated policy framework that is being considered at the fund recognizes these much better than the IV. So the fund is now has two policy tracks that are going to come into greater conflict. One is the integrated view, the institutional view on capital flows, and one is the integrated policy framework. And I hope these are removed or at least addressed better when the IV review is done next year. Thank you.
Thank you so much, Adnan. And indeed, I think the work on the integrated policy framework is really advancing quite fast. There will be I believe, a report summarizing its principal conclusions reached so far within the next few weeks. And I think it does raise a number of challenges for the IV, which are in many ways very complementary to the work that that we have done in our evaluation. I think we bring a lot of wealth of country experience, and we look at multilateral perspectives, source country perspectives. The IPF brings pretty deep thinking on the conceptual issues and some good empirical evidence. So I really recommend to people to look at that material as it becomes public. So thanks very much for the three panelists. I think they've really provided a good range of issues and perspectives. And I'd like now to open it up to the full range of participants to ask questions to the team or to the panelists. Please use the chat function to indicate you'd like to raise a question, and I will pass the baton in turn. Please keep yourself muted until it's your turn to speak. A number of people have already raised a number of questions in commenting. I don't see anybody coming with a specific question for the panelists, but I don't know whether Ted. I think if Ted Truman is still here with us, you raised a question about distinction between inflows and outflows. Ted, would you like to raise a question? Are you online?
Yes, well, I was just, thank you. I think this is, I'm impressed by this report. I would think that if I were still teaching, I would assign much of it to my students. So you've done a public service, independent of how it may impact fund policies. But when I was listening to you on the talk about the report and the policies towards preemption, I wonder if you, and maybe it's in the body of the report, I only read the executive summary, whether you make a distinction on preemption on outflows and on inflows. It does seem to me that, well, a priori on outflows, it's more likely that in some sense, that the restrictions will be imposed preemptively to avoid the use of other policies, if it may put it that way. So the push factors, in some sense, are coming from the country, at least to some more substantial degree, than when you're dealing with inflows. And I wonder whether the report and that part of the report or the background paper, relevant background papers, makes that distinction.
Thanks, Ted. Maybe I can ask Prakash to respond to that. And then I see we have a question from Joe Gagnon coming in, so I'll turn to Joe Gagnon next. Prakash?
Thanks, Charles. I also wanted to thank the discussants. Let me just quickly say, I think I agree completely with what Steve said at the end, namely that, allowing for more preemptive and long-lasting use would make all these labeling issues, less important and could make much of it go away. So I don't think we are suggesting removing the labels. I think the labels serve a function. What we are trying to do is to, as I said on the slide, reduce the fact that difficult labeling decisions lead to a fork in the road in the advice. So by making it preemptive and more long-lasting, that take that distinction away. So keep the labels, but don't make it lead to such a dramatic difference in your advice. And I also I agree with Adnan that we can't be too optimistic based on past record of the influence that we can have on individual source countries or even them countries as a group. I think that's why we went in a slightly different tack this time by suggesting that the frameworks for securities regulation could be worked on in a kind of multilateral setting rather than name and shame individual countries and go after them, just as we have with Basel III reform. Some of the banking regulations, maybe securities regulation could be the next big project the IMF could tackle. And indeed, fund staff have been working with IOSCO and FSB on exactly that. On Ted's question, I think, yes, in general, there is still a presumption that outflow controls are going to be somewhat less effective than inflow controls. And so when it comes to preemption, I think the same thing goes through, that many of our arguments are indeed for preemptive use in the case of inflows. But I would say that there is a case which we make in the paper that even in the case of outflows, a bit of allowance for preemption could increase the space for the use of standard macro tools. So I would not back away completely. Somewhat greater preemptive use in the case of outflows, but I would buy the basic premise that a lot of our arguments are indeed for the use of preemptive controls in the case of inflows. And the examples we gave of Korea, Peru, and Iceland in 2016 are indeed all cases where these were countries facing surges.
Thanks, Prakash. And I agree with you. I think there's a stronger, clearer case for preemptive use in the case of inflows, although even for inflows, I think it's in specific circumstances. With outflows, there's more concern about damaging reputation of a country, of its commitment to letting markets work. On the other hand, there are circumstances where you may get herd behavior or momentum in markets that can be quite damaging even before you get to a crisis. And I think the cases of China and India in our case studies sort of illustrate that. So as Prakash said, we think this is certainly worth considering more, although it's more difficult. I mean, one interesting question we asked when we talked to market participants was how they were felt about countries imposing capital controls. In the past, the conventional wisdom has been that markets really punish countries that put on capital controls. And I think that remains the case in many circumstances, but market participants also said that where capital controls were actually helpful in reducing the risk of a full-blown crisis, then actually they could play a useful role. Let me turn to Joe Gagnon for a question.
Oh, thanks, Charles and Prakash. A great report. I found myself agreeing with the idea of even further uses for controls, but I really wanted to ask about sort of important ways to really guide controls so that they aren't abused. Prakash mentioned controls in the context of the external sector reports, and Steve mentioned not using foreign exchange intervention or controls to undervalue currencies. And Ted's question made me realize that I've been assuming that controls are always either targeted against inflows or against outflows. And if there are some controls out there that sort of clamp down on all flows in both directions equally, my question may not make sense for those, but assuming that controls are more targeted, I guess my question is, would you imagine using your external sector report really as a foundational macro guide to capital flow measures controls? When I look at the external sector report, I like very much the way it's set up. For most countries, I think the norms of current accounts, which of course are the accounting identity flip side of capital flows, current account norms are sensible, with only one notable exception, which I won't go into today, but it's a number of medium-sized countries with surpluses that there's a blind eye in the external sector report to their surpluses that could be easily fixed. But assuming they had good norms, which I think is true for most countries, then you could say capital flow measures that serve to narrow undesirable excessive imbalances away from these norms are good, and those that support them or even enlarge them are bad. And is this not a sensible way to rule on what CFMs can be supported and what not? Prakash made the example of Thailand. I think Thailand is a horrible example because I think they have actually had very excessive foreign exchange intervention and perhaps capital flow measures to support an excessive current account surplus according to the ESR's own methodology. There may be other more granular micro elements to also judge, such as controls that reduce currency mismatches are good and those that increase currency mismatches are bad. Maybe what we need is a very clear enunciation of this as a guide towards the controls. And the final little point is that one thing I just see in so many of the IEO papers, and this one too, is a discussion of pushback from member economies against the IMF's advice. And I think it needs to be clear, sometimes it carries the sense that, oh, this is critical of the IMF because members disagree with them. And of course, that isn't necessarily so. I mean, it might well be the IMF is right and members are wrong. And I wish the report would take a stand more often. Thank you.
Thanks, Joe. Very good questions and thoughts. In the interest of efficiency, let me just throw in a question from Subad Berry on a similar topic before handing back to Prakash. Subad asks, does the report discuss issues connected with currency manipulation and exchange rate intervention? Prakash.
Thanks very much, Joe and Suman. Yeah, I think in the report we discuss in some detail that that there's always a worry if you go along the lines of some of the suggestions we make that there aren't enough safeguards and there will be an anything goes environment will develop. But what we argue is that the IMF does have safeguards in place, including most notably, as Joe said, the external sector report. To us, that is indeed the place where the IMF should be saying if the use of capital controls is leading to exchange rate manipulation, and IMF should be very firm in drawing those links. Unless my good friend Daniel Lee and his team have done work in the interim, my understanding is that at this point, the linkages between exchange rate valuations and the use of capital controls in the exchange rate models are extremely weak. There is a regression of exchange rates on my good friend Dennis Quinn, who's I think in the audience, on his capital restrictiveness index without even distinguishing between the direction of the flow. So it's very rudimentary. It definitely needs to be improved. At the very least, as your question, Joe, suggests, distinguishing between the direction of the flows. I mean, how are you going to judge whether capital controls are affecting exchange rates one way or the other if you're using an aggregate index that is not even distinguishing the direction of the flow? So the IMF has the safeguards, it has the frameworks, it has the mechanisms already in place to be very clear if it thinks that countries are using capital controls to manipulate the exchange rate. And that place is the EBA discussion and the external sector report. So completely agree with you on that. I have lost track of Suman's question. Charles, would you mind?
Yes, Suman's question was, does the report discuss issues connected with currency manipulation and exchange intervention?
Yeah, so I think I have sort of answered that. I mean, it's not, obviously this evaluation is not an evaluation of the external sector report or of the exchange balance assessment. I mean, we did do an update of those exercises, an update of our assessment of those exercises some years back, but this is not a full evaluation. So at this point, all we have done is to draw out the fact that the connection between the institutional view framework and the external sector report could be tightened much more than it is. And indeed, the IMF should be calling out countries if it thinks that they are using capital controls to manipulate the exchange rate.
Thanks, Prakash. Let me now turn to Livia Straka. Then I have questions from Taka Ito and Dathan Converse. First, Livia.
Thanks a lot. I have the following question. So the institutional view as this kind of lexicographic structure. So basically capital controls are last resort. Structural policies or macro fundamentals should come first. So I'm not sure if the report addresses this at all. So that would be my first question. And the second question is whether, especially your case studies, did you encounter any kind of case of trade-off? For example, the capital controls, working too well, and preventing incentives for putting, the structural policy in the right place. So did you actually encounter, empirically any evidence of this trade-off, which is at the basis of this lexicographic structure of the institutional view? Thank you.
Prakash, you want to respond to that?
Yeah, I'll respond, but also want to bring in Nicoletta for elaboration.
Okay.
So Livia, this also goes to something that Adnan was saying. The IB does indeed have a structure where you have to go down the decision tree fairly far until you reach a point where you can say, yes, capital controls are blessed by the IMF. And so our sense from the country cases and from the recent research, both the background paper by Anton Korinek as well as the recent work on the integrated policy framework, suggest that, and the paper by Peter Montiel, is that the conceptual and empirical basis for this lexicographic approach doesn't really seem to be there. In other words, there isn't really a sense that you should be thinking about the other policy instruments first and then look at the trade-offs among them and then reach a decision on whether or not you will use capital controls at the end of that process. So most countries, in fact, we found in our survey, are not using capital controls all that much. It's a tool that is used fairly sparingly, but when it is used as part of a policy mix. And indeed, countries are looking at what are the trade-offs between using one instrument versus the other to meet a certain set of policy goals. So I think we would support the view that it doesn't need to be exactly the way it is in the IV right now, that what we want to give countries is somewhat more flexibility to think about what is the set of policy instruments that would get us to desired goals, which in most cases are kind of financial stability, and sometimes, as I mentioned, things like housing affordability. But generally, countries are trying to achieve financial stability through a set of goals, through a set of instruments: foreign exchange intervention, capital controls, macroprudential measures, as well as standard policy tools. Let me turn to Nicoletta. I think she may, through some of the Latin America case studies, give you a better sense of how countries are actually viewing their decision making. I'm thinking of the case of Peru, but she may have others in mind as well. Nicoletta?
Thank you, Prakash. Yes, I think in response to Livia's particularly the question on whether countries, we've observed in our studies whether they use these measures in substitution of other measures and the lexicographic framework that the IB provides. Prakash said we didn't find any strong evidence of that. And what we did to measure it, we actually, in one of these papers, the one I wrote with Luigi Durand, also online, we measured using fund frameworks, policy imbalances. And so we could actually get a grasp of what the fund should be meaning, we suppose, by warranted macroeconomic adjustment. So if a country was moving in the direction of what the fund defines a macroeconomic adjustment, we measure that. And then we cross benchmark that against the use of capital controls or capital flow measures. And what came out is that countries use capital flow measures very sparingly. And in a very targeted fashion, even when they're under severe stress. Now, there could be a number of reasons to that, but in the past, I've done work, as you know, on inflation targeting. And when you look at a combination of policies, for example, under hybrid inflation targeting, you only have to use a very little bit of one of the tools sometimes to achieve a lot of the benefits. So I guess what we're trying to say here is that, to reaffirm what was said at the beginning, this is not an anything goes, but even a little bit of this ingredient has proven effective and useful to a lot of countries. And that's the case. But I was mentioning, for example, that Peru is a country who is coming off a history of high dollarization, high financial dollarization, and has combated that with an integrated policy framework that included measures to control ins and outs of cross-border transactions, because also domestic residents have a tendency to have double accounts in different currencies, and some of these are unhedged. And so there's quite a lot of movement going on, and that can be quite disruptive, not just for the effectiveness of monetary policy, but more generally for the strength of balance sheets at home and those that pose exposures to abroad. And what Peru has shown is that using parsimoniously a barrage of different policy levers, being extremely effective at reducing dollarization. And the fund has, and we narrate this in the background paper, the country case on Peru and Latin America. And the fund has been not, pointing out that this use should have been discontinued of some of these measures in line with the IV. There's been heavy discussions about labeling. And eventually, the fund very recently has put out work where it actually acknowledges that perhaps Peru has found a good way to do this, and maybe almost like doing a mea culpa on many years of criticism. I encourage you to read the report on Peru, because I think it's very telling about some of our conclusions in the May report. Thank you.
Thanks, Nicoletta. So a question from Taka Ito. I don't know whether, Taka, are you online? You could ask the question directly yourself.
Yeah, I'm here. So first of all, Charles, congratulations. This is a very good report. And I was leading the team in 1995, 25 years ago, on the Mexican crisis report, and we struggled to sort of justify a little bit of the use of the capital controls, or keeping the capital controls which were already in, and we had a substantial resistance at the board. So I really feel that this we came a very long way. My question is the use of self-insurance, so-called self-insurance, which is piling up the reserves so that you have the flexibility to as a buffer when capital inflows and outflows happen, in addition to other measures. And this is quite popular among the Asian countries. And they still have some IMF stigma, so they try not to get into the program at all costs. And I wonder whether this piling up foreign reserves, self-insurance, is recommended or not, and whether there is some numerical measure that what is too much and what is too little in terms of forex reserves. Thank you.
Thanks, Taka. Prakash, you want to respond to that?
Yeah, very quickly. We have a minute. Thanks very much. I covered that a bit, but maybe went over it too fast. As you know, the IMF does have an assessment of reserve adequacy, for different countries using a particular metric that it has in mind based on several considerations. And what we found is that this metric has not always been satisfying to the country authorities. I gave the example of China, for instance, where the IMF advice was that the country had way too much than what was needed based on this adequacy metric. But then China lost about $1 trillion, 25% of its stock over several months, and the Chinese officials felt justified in thinking that their stock was not too much if you could lose $1 trillion of it in a 2-year period. The other cases we talk about in the report are countries like Poland and Croatia, where the IMF was on the other side, thinking that these countries didn't have enough, but these countries thought that they had plenty for insurance. So there is, as you say, still a bit of IMF stigma, particularly in Asia. When we did a report last year, we talked to several authorities who felt that was still the case, that they had difficulties in applying for things like the flexible credit line because it was still not okay to have even a precautionary arrangement with the IMF. So I think that stigma does indeed lead to what may be from that perspective thought of as excessive self-insurance through building up of reserves. But in this particular report, we found that there are cases on both sides where there are disagreements between officials and the IMF, either that reserves are too high or that they are not high enough.
Thanks, Prakash. I mean, we've reached 11:30, but I mean, I think we'd be happy just to continue to respond to the remaining questions. And of course, people should feel free to leave, and certainly appreciate that the panelists giving us substantial amounts of their time. But why don't we just finish off the questions that have already come in. We have one from Nathan Converse on high frequency data, and then we have Whitney Minyan, who I think has some questions on Peru. So when I turn to Nathan.
Hi, I'll say at the beginning, the report was really excellent. Really enjoyed reading it. So at the beginning of the presentation today, actually, the IIF high frequency data made an appearance, and I think that really highlights that type of timely high frequency data has become almost mandatory in doing serious monitoring and analysis of capital flows. And in the IEO report, it's mentioned several times that data is very expensive, and that it's even been a barrier for IMF staff to access that data because of the cost. Not just, I don't want to pick only on the IIF, there's other sources of timely high frequency flows data, but they're all very expensive. And given that actually a lot of that data is kind of harvested from central bank and capital market regulator websites, is there a case for the IMF to do more to gather and disseminate that data in a less costly or even free manner, given that it is kind of a public good that not only the IMF, but countries all over the world would really benefit from having access to? Thanks.
Thanks very much, Nathan. Prakash, will respond to that?
I'll actually turn it over to Nicoletta. I know she feels passionately about this, but I think you're right. We have been fairly surprised that the IMF has faced resource constraints in this area. You would have thought the IMF would have access to a lot of the data that is needed for real-time monitoring. The IMF brought some people over from IIF actually, and they started a capital flows monitor, which has proved really helpful, but I think more could be done. But let me turn it over to Nicoletta.
Thank you. Well, in the report, we do look at this tangentially, and there are two sets of data actually that we talk about quite a bit. One is of course, financial capital flows data, and we are a member of the IIF, and we use that data. But as you know, that data doesn't have full coverage, and we have a much more universal membership than the 4 it'd be just adequate, I think, for the fund to have access and monitor a much larger group of countries. And to do that, I guess we would need to set up some sort of monitoring ourselves, because the IF itself gets data from the countries, and we would have to set up something analogous there. And as you know, the IF also has this top-down models and bottom-up models, so it's not just data, historical data, but they actually have some analytical tools to project the data forward at a higher frequency, especially monthly frequency. So we suggest, that is evaluated as a possibility, especially in support of a stronger medium-term agenda for the fund on, observing just the global financial cycle, but also capital flow conditions of the countries. The other set of data we talk about quite a bit is the area, because the area is produced or at least assembled by the fund based on communications by countries of changes in legislations about restrictions on capital transactions and the financial sector. And that data is a tremendous public good that serves not just academia, but really, the making of policies. And one thing that we point out is that, of course, it's very difficult to give advice on capital flows in the void of a relative sense of where other countries are standing. And so to have a good, precise, accurate measure of where everybody's restrictions are, it would be very good thing to have. And MCM, the department of the fund that cares for the area and produces a report, has limited resources dedicated to that. So we ask in the report to look into this too and consider the possibility of expanding resources there, because having a good idea of where restrictions are and how they evolve makes a lot of difference. And there's one chart I'm going to encourage you to look at, which is a chart that compares some of the traditional indices of capital restrictions like the Chin-Ito with the measure produced by now a staff member, Gurna and Pasricha, that shows a higher frequency behavior of changes. And it gives you a completely different picture, for example, of China. These appreciations are important to advise on policy. So your question is very important, and we think that data plays a very central role in the ability of the fund to improve its advice.
Thanks very much, Nicoletta. So we turn to Whitney Minan for the final question. Whitney works for Gestión, the newspaper in Peru. Whitney.
Hola, I know you've got a study on Peru, but what comment would you have on Peru? What has been behavior and what could we expect going forward? Also, in the current context where macroeconomic strength could be lost in pandemic, what will happen with this country?
Thanks, Whitney. It's not really our role to comment on Peru's current situation and prospects, but I think the case study on Peru that Nicoletta prepared is interesting in really highlighting in many aspects in which Peru is really leading the way in dealing with capital and account volatility. I know, Nicoletta, you want to make a few comments on the findings of the Peru case study?
I guess I can. I think the main point that I like people to take away from Peru is that Peru is a country that has consistently done what the fund calls warranted macroeconomic adjustment. It's shifted gradually and with a great degree of analytical investment into the world of targeting inflation. It's been one of the best performers on inflation in the region. I think it was the second lowest level of inflation in the region for years. It is very prudent fiscal policies, and it's a country that has, of course, during the super cycle, commodity cycle in 2006, 7, 8, just before the crisis, has been the sort of the star performer on stock exchanges globally. So it did, I think, over 100% stock exchange in 2007. And that meant that being prudent, it actually attracted a lot of flows. So being prudent, of course, is a good thing, but at the same time, it creates capital flow volatility, at least in terms of, receiving floods of money of people that see you as disciplined. And in that context, being dollarized, it struggled to find ways to, keep financial stability in place and not bubbling up. It had issues with house price asset bubbles. It had issues with, credit bubbles coming in. And I think what it's continued to show, and that also, we can say we have refreshed the papers for COVID, but we don't really assess fund advice under COVID. It has continued to show a great accuracy in policy. What we also see is that all this great ability and thoughtfulness in policy is actually not shielded Peru from very high volatility. And so Peru remains, exposed, of course, like other countries in the region, to high volatility. And it claims that it needs these tools, and it does so in a financial stability context. And that's, I think, where we got some of the inspiration also from other countries, that these measures and these tools are important in countries that under particular circumstances. So I think we won't talk today with you about what is going to happen to Peru, but I think if you read that, you can extrapolate that good policy will lead to good outcomes in the medium run, certainly, and that Peru provides an example of good policies, including on CFMs, to the region and beyond. Thank you.
Thanks very much, Nicoletta. And I think at this point, I'd like to wrap things up. I'd like to give a big round of thanks to Prakash and Nicoletta. Prakash for the presentation, and both of you for the responses to many interesting questions. And a big round of thanks to our panelists, to Patrick, Steve, and Adnan for really providing some interesting perspectives and suggestions and comments on our evaluation. And thank you to the many participants from around the world for being interested in our report and contributing, again, further interesting comments and questions. These are complicated issues. It's an extensive and complicated report. I think many of you have already taken a careful look at it, which we really appreciate. And for those of you who are interested to see more, it's available on our website. I have to say I'm really thrilled about this event. We've got a lot of interest, and I think it's provided us with an opportunity for a rich and deep discussion of our report. When we write a report, we're not just interested in writing a good report, but also in having an impact on the way the IMF conducts its business. As Prakash said, there will be an implementation plan within 6 months. There will be, the managing director has already promised a review of the institutional view for next year. But I think, to the extent that we're raising issues that are already being considered in the fund, but I think to the extent that they're also being considered outside, externally, that will be helpful to the fund staff and board and management to find a sensible way ahead. These are difficult issues. There are at least 3 hands, maybe 4 or 5 hands to consider when thinking about these issues. So if we've helped to contribute to a debate on an important topic and eventually lead to some fine tuning, I don't think the institutional view needs a major overhaul, but I think that there is some need for fine tuning in order to make sure that the fund can give state-of-the-art advice in this area. So thanks to everybody for participating. We'll post this recording on our website, or the PowerPoint that Prakash gave will also be available. So thanks very much for everybody, and hope to see you at a future event. Thank you. Bye-bye.
Thank you, everyone.